Hello and welcome to Calling Monster Finance. It's September 26th, 2025. Today, 36th, the U.S. markets snapped a three-day losing streak, closing the week with a decisive rally. The overarching theme was one of relief, as investors found comfort in new inflation data that met expectations, reinforcing the belief that the Federal Reserve will continue on its path of monetary easing. However, this broad-based optimism was tempered by significant crosscurrents. New tariff announcements created sharp divergences between sectors, and a cautious outlook from a major retailer highlighted underlying concerns about the consumer. Coming up, we'll break down the key macroeconomic drivers behind today's rally, analyze the impact of new trade policies, and look at a major earnings report that has the market talking.
Today's positive close marks a significant reversal from the turbulence seen earlier in the week. After touching an all-time high on Monday, the S&P 500 endured a three-day pullback. Paradoxically, this anxiety wasn't sparked by economic weakness, but by strength. An upward revision to second-quarter GDP growth had fueled fears that a resilient economy might force the Federal Reserve to reconsider its dovish pivot. That narrative shifted completely today. The catalyst was the release of the August Personal Consumption Expenditures Price Index, or PCE, which is the Federal Reserve's preferred inflation gauge. The report came in squarely in line with expectations, providing the Goldilocks moment the market was looking for, not too hot to force the Fed's hand, and not too cold to signal a sharp downturn. The relief was immediate and palpable. Now, let's take a look at the final closing numbers for today, starting with the major U.S. indices. The Dow Jones Industrial Average closed at 46,247.29, a gain of 299.97 points, or 0.65%. The S&P 500 index finished at 6,643.70, up 38.98 points, or 0.59%. The Nasdaq Composite ended the day at 22,484.07, adding 99.37 points for a gain of 0.44%. And the Russell 2000 Index of small-cap stocks rose 23.28 points, or 0.97%, to close at 2,434.32. But the macro story wasn't the only one in play. Late yesterday, President Donald Trump announced a new volley of tariffs, which created immediate and sharp divergences in the market, rewarding domestically focused companies while punishing those reliant on imports. And in the final hours of trading today, reports that video game giant Electronic Arts was nearing a deal to be taken private added a jolt of M&A excitement to the session. Ultimately, today's session was a microcosm of the current investment landscape, a market buoyed by the prospect of lower interest rates, yet simultaneously navigating the crosscurrents of a resilient economy, unpredictable trade policy, and major company-specific events. Let's take a deeper look at the two main drivers that shaped today's trading. First and foremost was the August PCE report. The headline index rose 2.7% year over year, while the core measure, which strips out volatile food and energy prices, held steady at an annualized pace of 2.9%. Both of these figures landed exactly in line with consensus forecasts. For a market laser-focused on inflation, this was interpreted as an unequivocally positive signal, a green light for the Federal Reserve to continue with its bias to cut interest rates. This relief was clearly reflected in the CBOE Volatility Index, which plummeted 8.66% to 15.29, signaling a sharp decrease in investor anxiety. The second key driver was commentary from the Federal Reserve itself. In a speech today, Fed Vice Chair for Supervision, Michelle Bowman, provided crucial clarity on the central bank's thinking. She stated that with many months of deteriorating labor market conditions, it was time for the committee to act decisively and proactively. She argued it was appropriate to look through temporarily elevated inflation readings to avoid more persistent damage to employment. This was the confirmation the market was waiting for, cementing the belief that the Fed's focus has shifted toward supporting the labor market, even if inflation remains above its target. This policy signal helped sustain the rally throughout the day, even as the 10-year Treasury yield ticked slightly higher to close at 4.19%. Looming in the background, however, is the increasing likelihood of a U.S. government shutdown next week. While this political risk did not derail today's rally, it remains a key concern, as a shutdown could delay the release of critical economic data, including the all-important September jobs report. Adding another layer of complexity to the market narrative were new trade policy announcements from President Donald Trump. In a series of social media posts late Thursday, the president announced a sweeping new round of tariffs set to take effect on October 1st. The tariffs target a range of goods, including a 100% tariff on branded pharmaceuticals, a 25% tariff on heavy trucks, and significant levies on furniture and home goods. The administration invoked national security as the legal basis for these measures. However, a crucial detail was embedded within the pharmaceutical tariff. The 100% levy would not apply to any company that is currently building a manufacturing plant in the United States. This provision effectively transforms the tariff from a simple import barrier into a tool of industrial policy, designed to compel the onshoring of global supply chains. While this news did not derail the broader market's rally, it did create stark divergences. The S&P 500 industrial sector, which includes domestic manufacturers, posted a strong gain of 0.87%. Conversely, the policy weighed heavily on import-reliant retailers, a dynamic exemplified by Costco, which saw its shares fall sharply by 2.90%. Turning now to corporate earnings, warehouse retailer Costco reported its fiscal fourth quarter results, and the market reaction was telling. On the surface, the numbers looked solid. Costco beat Wall Street's earnings per share estimates and posted an 8% increase in total revenue. However, the details revealed a more cautious picture. U.S. same-store sales growth came in slightly below analyst expectations. The main point of concern came from management's commentary during the earnings call. The company noted that consumers remain very choiceful and are beginning to pull back on discretionary purchases, focusing instead on essentials. This observation provides a tangible data point that validates the Federal Reserve's concerns about underlying fragility in the economy. It suggests that while the consumer is still spending, inflationary pressures are starting to impact behavior. The market seized on this cautious outlook rather than the headline earnings beat. As a result, shares of Costco closed down significantly, falling $27.36, or 2.90%, to finish the day at $915.95. While the major indices all closed in positive territory, a look at the sector performance reveals the structural divergences at play in today's market. The rally was broad-based, with 10 of the 11 S&P 500 sectors finishing higher. The leadership came from defensive and interest rate-sensitive areas, which benefit from the prospect of Fed rate cuts. The utility sector was the day's top performer, surging 1.59%. It was followed by consumer discretionary, which gained 1.45%, and real estate, which rose 1.05%. The day's only losing sector was consumer staples, which edged down by 0.11%. This underperformance reflects the crosscurrents we've discussed: the impact of new tariffs on import-heavy retailers and the cautious consumer outlook highlighted by Costco's earnings report. On the other hand, the industrial sector posted a solid gain of 0.87%, likely benefiting from the onshoring incentives embedded in the new tariff policies. This split performance between different consumer and industrial sectors clearly illustrates how today's market was driven by a complex mix of macroeconomic relief and policy-specific pressures. And now for the most actively traded stocks by turnover today. In first place was the SPDRS and P500 Index ETF, which gained 0.57%. Second was Tesla, which had a strong session, rising 4.02%. Third was the Invesco QQQ Trust ETF, tracking the NASDAQ 100, which was up 0.41%. Fourth was Nvidia, which added 0.28%, and in fifth place was Apple, which closed down 0.55%. In summary, today's market action was defined by a powerful sense of relief. Inline inflation data and explicitly dovish commentary from the Federal Reserve provided a clear runway for investors to price in future rate cuts. This optimism was strong enough to overshadow concerns from new tariff announcements and a cautious consumer outlook from a major retailer. Looking ahead, the market's primary focus will now shift to the upcoming September jobs report. That data will serve as the next major test of the Federal Reserve's thesis of emerging signs of fragility in the labor market and will be critical in shaping the path of monetary policy going forward. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.